Great Thursday morning to you guys. Thirsty Thursday, I used to call it back in the day. Thirsty for knowledge. And I used to go to real estate meetings that were local every Thursday. So if you're thirsty for some knowledge, here you have some, and you can find it in your local areas too. I'm headed out to Miami today for my birthday weekend with my wife and a buddy of mine. But I had a session with some students. Some students started with me like, a year and a half ago, 2 years ago. They are just getting tune-ups here and there. They've bought a bunch of properties, younger guys, private money, taught them how to raise private money. They've really done tremendous for themselves. Um, so I was talking about the math, about why real estate smokes the stock market, crypto, whatever. First off, it's definitely safer. It's bricks and mortar, stocks, crypto can go up and down. I do like crypto. I'm a big Bitcoin person. I think it's a store of value. I don't think you should invest in it unless you handle the volatility and you're just investing in it for 5, 10 years down the line. But you will be happy if you just park some money there. But let me give you the math that I gave them. So there's many markets, and obviously you guys know my favorite market right now is Cleveland. There's many markets where you can buy, let's say, $125,000 house, and you can either buy it the traditional, like put 20% down plus closing costs, or you can do a burr method. So let's use, like, I would say most people will put 25,000 down on this $125,000 purchase, whether they're doing the burr method and they didn't get all their money back, or they put money down. So let's compare $25,000 that you put in the stock market for 5 years and 25,000 where you buy a house. And we'll use Cleveland as an example, but it could be any market. And I'm going to just do the math right here. So let's start with 25,000 in the stock market. What do you think is a good return in the stock market for 5 years? Um, it goes up and down, and we've had a good run the last 10 years, but let's say 25% a year and no down years. Let's see what that is. So I'm going to times it by 1.25, 25,000 times 1.25 times 1.25 times 1.25 times 1.25. I could have done this before, but times 1.25. So if you get a 25% return for 5 years in the stock market, you invest 25,000 and you have no down years, which is a really good run. Let's just say you would have $76,293. Remember that number because I'm going to clear this out. Now, I can tell you my experience in the markets that I invest in, is if I buy a house in Cleveland for 125,000, where I put 25,000 in, down, your only investment is 25,000. So you could have put it in the stock market, but you put it in, right? And let's say you put it in Bitcoin and or some other cryptocurrency, which I don't recommend them all. Who knows what that could be? It could be up, it could be down, it could be whatever. But for the most part, most of my property double every 5 years, right? So does that mean that my 25,000 would be 50,000? No, you're not doing the math. You leveraged the real estate. So your $25,000 investment got you a $125,000 property. That means the property would be worth 250,000. So I'm going to do the math and then I'll just come back from this if you think this is too crazy. So 250 minus your 125 is $125,000. So you made, instead of the 79,000, you made $125,000 in the real estate scenario because you're leveraging money. Now, let's say you think, there's no way that house is going to double. Well, okay. Let's say it goes up 50%. And this is not 50% per year. This is 50% in 5 years. So, that's less than 10% per year for a property. Now, we could get into appreciation, different markets, this, that, and the other thing. People have this false idea that appreciation comes in A neighborhoods. Appreciation is already in A neighborhoods and they do appreciate. But where you get more bang for a buck is in a C neighborhood that's becoming a B or becoming an A. And that's really where I invest. But regardless of that, let's say none of that happens. You have inflation. Like that's why real estate is a great asset. You're going to have inflation. Now, I'm not even talking about any cash flow you get from these properties. So assume you get zero cash flow, it's just break even. You're just making your money from the appreciation. Well, in the stock market, with a great 5 years of 25% returns and no losses, you're going to have 79,000 from your 25. In the real estate, you're going to have 25 plus 125, so you're going to have 150,000. It's almost double. So let's say the property doesn't double. I'm having such a darn time with this calculator. So let's say it only goes up 50%. So 125 times 1.5 is 187 minus the 125 that you got a $62,500 plus your original 25,000 because that's how the stock market works. You got 87,500. So this is if the property goes up around 8 or 9% per year. And I can assure you, all these properties do that. I have never in 28 years, I don't know what anybody's talking about, hey man, if you buy in the hood or you buy in a C neighborhood or you buy in one, I've never had a property go down in value. Never. Now, are there blips? 2008, this, that, and the other thing? Absolutely. Do they go down in value temporarily? Yes, but they always come back and skyrocket. And if you buy cash flow property, you do not have to you don't have to sell when the market's down. So if I have a cash flow property, I'm making $500 a month, every month, and the market tanks, like, I'm still making $500 a month. I'm not going to sell it. Don't sell it then. So I have never had a property that didn't sell for more money than I bought it for. And we're talking about thousands of properties. So we're not talking about like 50, talking about thousands of properties. So here's the other thing. I just want to make sure you understand. If you went to somebody and said, hey man, can you lend me $100,000 to buy Bitcoin? If you went to a bank to do that, would they do that? Absolutely not. They would say, well, you got to put up some money and we'll give you we'll give you a percentage of the money that you put up, okay. If you went to the stock market, unless you're a baller and you put collateral of other stocks, and buy on margin and can be called on margin, you can't do it. But with real estate, you want to buy a $125,000 property. Yeah, somebody will give you $100,000 to buy the $125,000 property. That's leverage. That's why real estate's great. Also has tax benefits, also is brick and mortar, also cash flows monthly. So if you're not in real estate, I don't know what you're doing. So hope that gives you guys a little insight into why I love real estate. And I'm the real estate doctor. Have the best day of your life. Thanks, guys.